record.
I would sounds good.
Okay.
Is my lighting okay?
Your lighting's good, man. You look good. So, let's start off with I don't know what this serious doesn't matter, but I'm gonna be nitpicky. Boom. The racket. All right, so let's talk about a couple of different life insurance based products so that we provide a little bit of education and people can know what might be the right fit for them. I'm joined by my good buddy Brian Garcia Larson, who's another really phenomenal producer in the life insurance space and knows everything there is to know about really all these products we're going to talk about today. And I guess, Brian, I wanted to talk, first of all, about term life insurance. So term life insurance is kind of that main thing I think a lot of people, get quoted when they do look at a life insurance policy. So tell me a little bit about, what term life insurance is.
Yep. So term life, for me, as I'm talking to clients, a lot of times a client maybe isn't even sure what kind of coverage they need, right? So it's our job to really dig in as a fiduciary that we work for the client and not the insurance carrier, that we're there on their side, that, we're there to help them with their meet the needs to protect their family. So, you talk to a lot of people that maybe just bought a house or they have some debt or they just graduated from college. Maybe they just got married. They're thinking about starting a family. Term coverage is a great product to cover the today problem. It's not necessarily a long-term fix, but it's definitely a very affordable way to be able to protect, you know, that their debt. Basically they're protecting their income. So you take a family of a young family in their early 30s or late 20s or whatever that looks like in today's world, and maybe they have a house, maybe they have some student loans, they have a car, maybe they're two income families in today's world, and if one of them doesn't come home tomorrow from work, like what happens to that family? And I think a lot of people don't really think that that could happen to them, but yet we know the statistics that it happens every day to people, to good people. Bad things happen to good people every day, unfortunately. But to know that, hey, we're not going to have to worry about where we're going to live tomorrow. We don't have to worry about if our kids have to get uprooted and move to a different city to live with family or whatever that looks like. We can just focus on grieving. We can focus on getting our lives back together, and we don't have to worry about if we're going to have a meal the next day, and we don't have to worry about where we're going to live. And term
Yeah.
term coverage, we can set that term for 10 years, 15 years, 20 years, 25 years, 30 years. You can have it set up to where 100% of your money that you put into that policy you can get returned. It's called return of premium. So really effectively, did that policy cost you anything if you outlived it? No, because you treated it like a savings account. I mean, what are you going to get at a bank in a savings account? A 1/4% interest? I mean, at the end of the day, it's really about nothing. So, you can get a 250, 300, half a million, up to $1 million of coverage, $2 million of coverage, and get 100% of your money back to protect, that earning potential that you might have, or protect that property so your family's got a place to live if you don't come home tomorrow. And really, that's the biggest benefit of term coverage.
And that's good. And I actually want to maybe let's talk a little bit about that because and let's show maybe a live example because you just talked about the value of a term life insurance policy that does have living benefits on it. Or excuse me, you talked about return of premium. We're also going to talk about living benefits. So let's say that we have someone who is they're 30 years old and we're looking at a policy that is going to be, guaranteed for the next 30 years. So that means that if they were to pass away, their family is going to receive $250,000 in a death benefit, a tax-free death benefit, anytime in the next 30 years. Now, that option, it would be a monthly premium of $117.66. So what does that mean? That means that family is going to pay $117.66 every single month for the next 30 years or until they pass away, if that were to happen in that 30-year period. If they pass away, their family is going to receive the $250,000 death benefit. Now, let's talk about what happens if they outlive the policy. So now at year 30, they're either going to get every single premium returned to them, meaning this 42,357. That would be the check that they could get back from the insurance company, or what they could elect to do is what's called a reduced paid up term life insurance. Basically, what that means is you're saying, I'm not interested in receiving my money back from the policy, but I am interested in still having life insurance to pay into anymore. So what they could do is instead of getting that $42,000 back, they can say, I want this $99,000 death benefit for my family for the rest of my life. So now this person is 60 years old. They're not going to have to pay for life insurance. And no matter when they pass away, they've got roughly $100,000 death benefit that could take care of them and their family in the event of, they did need that burial, final expense, things of that nature. But you explain that beautifully. And like term life, it really just has a start date and an end date. And if we're looking at the most amount of coverage for the least amount of cost, it would be term life insurance that has a start date and an end date. And if we did want to have the return of premium rider, we could do that. So if we go back to this exact same example, let's say that we did want to do that same 30-year plan, but we weren't concerned about getting our money back and we'd rather pay less every month. Well, we could do that. Now the policy is $60.74 a month. It's going to have that $250,000 death benefit. It's just that in 30 years, the policy is going to expire. The client isn't going to get anything back from it. And the idea there is that you take people through the reason it has a term length that expires is it takes you through a time period where there is a heavy need for insurance. So, for example, if you're 30 years old, you potentially are, married and maybe you either do have kids or about to have kids, and there's a need for the coverage. The three main reasons people look into life insurance is for income replacement. They want to make sure if they pass away, the amount of money they make every month and every year still comes into the family so they can maintain that lifestyle for a certain period of time as they make that adjustment. The second thing is for debt elimination. So if people that have a mortgage or car notes or student loans, they want to make sure if they pass away that that debt doesn't roll over to the family and that there is a life insurance to pay that. And then the last thing is usually a funeral, burial, final expense. They don't want to have a GoFundMe page when they pass away for people to try and chip in and pay for that. And then, there's also things like, education and legacy costs. People just want to leave money to their family because they want to give them a little bit of a kickstart and help them out, or they want to be able to provide for their children's education if they haven't gone through school yet. So those are all the reasons people would get coverage. And 10, 15, 20, 30 years from now, that need for coverage is probably not the same. The kids are out of the house. They're already, past the time where they were paying for schooling. They're already past the time where they were dependent on you for providing. And they're off doing their own thing. And now your needs might shift. You might still have a mortgage, and you'll still have those final expense burial, but now that income replacement can become less of a concern. Brian, any other thoughts, man, about kind of term life insurance and maybe some tips and tricks as people look into what's the right fit for them?
Yeah, yeah. So one of the big perks, like we both just kind of touched on, but one of the things I like to reiterate with the client is, they're like, so that coverage just goes away, like we talked about. And I always tell people that you're in different phases in your life. You're in your 20s and I'm going to be 50 this coming week. And so we're in very different places of our lives, right? Age wise, just where we are. And I always tell people that you're not going to need the same coverage when you're 25 as you're going to need when you're 65, right? Like same as your health is going to be different at those ages. Your body's different. Everything's different. Your financial situation's different. And it's kind of like I always kind of think of term coverage as bridge coverage. So it's kind of like a bridge to get you over the troubled waters of life, when you're making a mortgage, you're paying your debt back, you're raising children, you have the bulk of the stress, right? And then when the retirement age hits, 55, 65 years old, 70 years old, whatever our country says you should work till nowadays. Um,
Mhm.
hopefully you don't have a marriage or not a marriage, a mortgage, excuse me. That's up to you. But hopefully you don't have a mortgage, you don't have student loan debt, and your need to protect, that debt, to carry your legacy off with your spouse, your family is completely different. And that's where I think the big thing is with term is you have to understand how to leverage that term so that you're not it's not a permanent fix. It's just a, let's cover the bulk of where our earning is, and where our debt's going to lie.
Yeah, that's good. And then the last thing I think we should talk about is living benefits. And living benefits are not necessarily only for term life insurance. Living benefits can apply to a number of different life insurance coverages, but I think they're really crucial. So when people think of life insurance, they generally just think about the death benefit. I die and X amount of dollars would go to my spouse, my kids, my grandkids, etc. What a lot of people don't always plan for is what if you don't die, but you have a heart attack, or you have a stroke, or you have some form of chronic or terminal illness that really impacts your ability to generate income, even though it might not kill you. And the big three are critical illness, chronic illness, and terminal illness. When we talk about living benefits, those are the three categories. A critical illness would be a heart attack, a stroke, a cancer. Those are the big three. One out of three people in their lifetime is going to have one of those three things happen, unfortunately. The second thing is called chronic illness. That would be if you cannot perform daily living activities because of some form of serious injury or underlying disease. And the daily living activities are eating, bathing, dressing, toileting, taking medications. And if you can't perform two out of six of those, you are eligible to receive a chronic illness benefit. And then the last thing is terminal illness. And depending on the different life insurance company, it could be 12 months or 24 months. But basically, a doctor says you have either 12 or 24 months left to live. And that allows you to essentially access the cash value faster, or excuse me, access the death benefit faster. So they call it an accelerated rider for critical, chronic, or terminal illness. Those are the living benefits. So if I'm meeting with somebody and they're let's just talk about our previous example. It was a $250,000 policy. They're 30 years old. Let's say that when they turn 55, they have a heart attack. Well, maybe that heart attack, doesn't kill them, but it knocks them out of their ability to generate income. Maybe they have to take 6 months of time off work as they recover. Well, most work coverages are going to provide some form of guidance and assistance there, but it's generally not your complete, income, and it's generally not for that long. So now that person could actually be eligible for up to 80% of that cash value. So if I take 250,000, multiply it by 80%, that's 200 grand. So you have someone who has a $200,000 check that comes to them. What a wave of relief that could provide in the event something like that can happen, Brian.
Yeah, it's pretty amazing. I have you know, I had 25 years in the workforce in corporate America, before I was smart enough to, get out of the rat race and do what you've been blessed to be able to do since college, and be self-employed, and help others. And you know the majority of the world has a job, right, that they have to go to, and they don't get a paycheck if they don't go there. And I've worked with many people over the years that have, been diagnosed with cancer. Like, the statistics is 1 in 2 men are going to get cancer at some point in their life, and 1 in 3 women are going to get diagnosed with cancer in their life. And let's just say, 80, 90% of those people are going to go through chemotherapy, they're going to go through radiation, and it's basically a race to see if the radiation is trying to kill the cancer, and hopefully it doesn't kill you before it kills the cancer. That's really just what cancer and radiation and treatment is. And those poor people, I've seen, numerous people either in personal, my family, and in the workplace, to where they're thrown up in garbage cans while they're at work because they can't afford to take the time off to miss 3 or 4 days from being sick from radiation or from chemotherapy. And we even have just regular cancer plans, like you said. You can get a plan that's, pays you 30, 40, 50, $60,000 if you're diagnosed with, you know a type of cancer that you're going to have to get treatment for. And that'll free up some income, right? Like maybe you can go to halftime, or maybe you work half days or 3 days a week or something, to where you're not worried about where you're going to live again. You're not going to worry about who's going to pay my rent or my mortgage, to where it gives you that time to be able to spend that time with your family. It gives you that time to heal, gives you that time to put that stress on the table, because stress is a massive killer, especially if you pair that up with some cancer or a heart attack or stroke. So, I feel that we're super blessed to be able to help families and educate them with these kinds of products. So there is a solution like, hey, we can't help you that you got cancer, but we can help you have a better quality of life to get through that process or that season of your life you're gonna need help with. And I think that's where you talk about those living benefits. They're just priceless.
Yeah. And I think not only are they such a good option for so many of the policies that we offer, they're actually built in without any additional cost. So when we talk about those two policies I mentioned, the term life, the 30-year for the 250 with the return of premium and then without the return of premium, in both cases, they have that living benefit built in. So, it's not something that you're necessarily having to pay an additional amount for. And while we're on the subject of talking about built-in benefits, I think we should maybe talk about the difference between fully underwritten policies and simplified issue or non-medical policies. So when you look at life insurance, and let's say that you walk up to one of the major excuse me, not life insurance, but major insurance carriers out there, and there's a few, and we won't start naming names, but maybe one of the jingles is "but a dum bum bum," or maybe there's one that has a commercial that talks about destruction and mayhem. So if you went to one of those guys and you asked them for a term life insurance quote, and let's say that you ask for that same $250,000 coverage on a 30-year term, in our example, it was about $60 a month. Well, they might tell you that it's $25 a month. And you think to yourself, well, man, why are Brian and Grant telling me that it's 60? Well, in the insurance industry, there are a couple of ways to get approved for coverage. The insurance company is, of course, going to want to cover themselves by taking a look at your health to make sure that like it's a worthwhile risk for them to allow you to pay, 30 or 40 or $60 a month. And if you die tomorrow, they got to pay out 250,000. They want to make sure that you're in reasonably good enough health to be able to qualify for that type of plan. Because if you have someone who has already some serious health conditions, we're probably not going to qualify for a term life policy, or if we will, it will be really expensive. So, what they look at when there's a non medical policy is they look at your prescription history and your health history through a couple of different databases. MIB is the big one, which stands for Medical Information Bureau. So they scan through these codes in a matter of some companies do it instantly. Some companies do it over the course of just a couple days, and then they make a decision if they want to approve you or not. That is the bulk of what we specialize in, which is simplified issue policies with no medical exams. Then there's the other side of the business, which are fully underwritten or medical policies. This is a policy where on paper, the quote is going to look lower. The reason the quote looks so much more attractive is because it is based on a very comprehensive medical review. You're going to have a nurse that's going to come out to your home and take several vials of blood. They're going to have a urine analysis. They potentially could ask you to do an EKG depending on the coverage and that company's requirements. And they're going to ask you a variety of different medical questions that go not only just into your current health, but they're also going to ask you about family members. Do you have siblings? What are the siblings' ages and health conditions? Your parents. Did your parents have a history of heart disease, for example, or cancer? Does that run in the family? Your family background with these fully underwritten policies greatly is factored in and could impact your rate and if you can even get approved. And so, from my experience, about 70% of policies that are fully underwritten are either flat out declined or they're issued other than applied for. And when we say other than applied for, that means that they say, we'll go ahead and give you the coverage, but we actually want to charge you a lot more money for it. Because what happens is in insurance, there's what's called a table rating. It's kind of like a credit score. And table zero means like you're as healthy as can be, you're within the perfect height and weight, you have no medical conditions, you take no medications, and your family history is perfect. You won the genetic lottery. That table zero to a lot of insurance companies are going to refer to as preferred plus or maybe an elite pricing. Only a very small percentage of people could ever qualify for that. And then from there, they have table one, two, three, four, five, all the way down to, table 12. Some insurance companies do it by letters, so they might go down to table G or H. And each one of those tables allows you to be slightly unhealthier to qualify, but they're going to charge you more money. So, for example, maybe you get approved at a table 6, and now instead of it saying, hey, it's $25 a month, now it's really $125 a month. So with non-medical policies, they actually took about 4 tables And they just said, if you fit anywhere between table 0 and table 4, you get one price. And we're going to be able to figure out if you can get approved, with some companies in 10 minutes or less, with other companies a couple days. With the fully underwritten policy, they're going to put you under our microscope for anywhere between several weeks to several months. They're going to have you do not only that medical exam, they're also going to order attending physician statements from any doctor that you've been to try and get them to give them a current status on your health. And then they're going to decide, are you table 0, 1, 2, 3, where maybe I can get you that $25, $30 a month policy? Or are you really going to fall into a table 4, 5, 6, 7, where now it's more expensive? So what happens in 70% of these cases is it gets approved at either the same cost of doing non-medical policies or even more expensive. And all it does is put the risk on the client, Brian. I remember a gentleman, for example, I sat with him a couple years ago. We talked about the different solutions. We said, hey, we can get you this coverage. And it was, I believe, around $100 a month if we did it without a medical exam. It was about $60 a month if we did get approved at a non-medical preferred rate. I told him the kind of the drawbacks of doing that. And he said to me, you know what, I'm perfectly healthy. Let's do the medical exam. So we did the medical exam. It came back with traces of tuberculosis. Now his premium goes from $60 a month to $260 a month. And he says to me, well, okay, let's just do the $100 a month one. You can't. Now your medical record is tattooed with the fact that you just had this exam that happened where they found out the tuberculosis. Now, instead of charging you the $100 a month non-medical, they want 260, and we can't go back to that. So this is a recommendation for everybody out there is if you have somebody showing you a fully underwritten policy that does require the medical exams, if you want to go down that route, that's fine. Just make sure that you do get a non-medical policy approved first that they can't take away from you. What's been your experience with that, Brian? Maybe the medical versus non-medical.
Yeah, yeah, exactly. So, and that's a great point. You talk about time, right? I always say time's a killer in any business because you take a client who has to wait 2 to 3 months to try to figure out if they can have a policy. I mean, we have to just hope and pray that nothing happens to them in the meantime. They're not covered tomorrow, like our non fully medically written policies. They're the simplified issue. We can have a policy in some of these cases. I mean, we can have a policy in their email in 10 minutes from the time we write the policy. It's issue paid and done. And you know, it's it's kind of like it's kind of like how the industry was always until about 10 years ago when we started having these policies where we didn't put all these people through the ringer of the anxiety of, am I going to get approved? And then if they don't get approved, like you said, it's on their records. I've had people, get declined, and then we've just fought and fought trying to get a policy put in place because, like you said, it's once they figure it out, right? The cat's out of the bag that now you're pre-diabetic or you're pre-tuberculosis or you have all these things that because they're like chickens in the feed, right? They're just pecking away trying to find something wrong with people and instead of really trying to figure out how can we help this family or how can we help these people. And that's been my experience is, boy, if we can figure out how to help somebody today, it's always much better than trying to wait until that better deal is not really a better deal. Because I've maybe had, I've been a licensed agent for 15 years. 2008 is when I got licensed in. And back then mostly everything was full medically underwritten. So I mean I had so many people back then that we just you couldn't get coverage for, or you'd quote them what the company said to give them a quote for, and then like you said, it wasn't even in the same realm of what their budget could possibly be. And you just got defeated as, am I really helping people? And I feel like the way the market is set up now for us to really make an impact on families is just really the way to go.
Yeah, 100%, man. So that's good. And I think the last thing, just to close the book on maybe kind of the term life policies without a medical exam or being fully underwritten, is keep in mind that when you're shopping for coverage, you want to work with someone that's a broker. Now, when you work with someone who's a broker, you're not like working with some middleman that you don't need. when you go into one particular company and ask them for a quote for coverage, they're only able to show you options for that one particular company. What we do as brokers is we represent dozens of different life insurance companies. And so we can show you a quote from Mutual of Omaha, Transamerica, AIG, Foresters, Gerber, etc. And we can really figure out, not only based on our, expertise in the industry, based on your age and your health and how much coverage you want, but also just based on what's the lowest premium available. So we can actually shop through all these carriers for you and show you which one is going to be the lowest coverage option. And so you actually need to be a licensed insurance agent to really shop around quotes. Like, you can go online and there's some free, quoting tools. A lot of them ask you to put in your info so that they can, kind of be able to follow up with you, and pursue you to talk about the coverage. But you really want to talk to someone who is an expert, because we think of all of our clients as someone that hired us as a trusted advisor. And when I say hired us, they don't have to pay us a dime. We get paid directly from the insurance companies only if and when a policy is approved. So what that means is that you don't have to pay us, or you shouldn't have to pay anybody to be an advisor for you. We're able to look around and figure out, but what is the best plan of attack based on what you're looking for through all these different companies, and then show you that option and help you apply for it. So that's another thing, just as you are shopping around for life insurance, is working with someone that not only has, a lot of experience. You've been doing this for 15 years. This is my seventh year doing it. But also that you have someone that has access to a variety of different companies, so that you don't get locked into just one company's particular product. For example, if you are a female over the age of 50, there's a company called American Amicable that offers incredibly beneficial term rates to you. And if you're a male who's over the age of 65, there's a company that offers really preferential rates for you based on just their sweet spot. So you would never know if you didn't spend all day long doing it. So make sure that you do find a professional that you can trust will take you down the right path. Um, so with that, I wanted to pivot into whole life coverage. So whole life, and it's funny, man, like, people seem to have either this, like, I love term insurance and I've heard bad things about whole life, or I only want whole life and I don't like term. And it's just kind of funny to hear, as I've met with clients over the years, them kind of share their thoughts on it, which, and a lot of it is based around their maybe experience with a friend or family member where, man, their brother had a term life policy that they paid into for 30 years, and then at the end of it, they got nothing back, and it was like maybe they didn't realize that that was the idea behind it. And then they have other people that have a whole life policy that they've paid into, and they've wondered why they've paid into it for 10 or 15 years and it hasn't really done anything for them. So I wanted to really clear the air about what whole life insurance is, and essentially it's a policy that's going to have a start date and zero end date. It is going to go on until you die, whether that's age 30, 40, 50, 80, or 119 years old. It's going to pay out that death benefit. It's guaranteed to pay as long as you make the monthly premium contributions. It does accumulate a small amount of cash value, and cash value is a very sensitive term because there's policies that have no cash value, such as a term life insurance without return of premium. There's no cash value there. That's the most amount of coverage for the least amount of cost. With whole life coverage, you are going to have a small percentage of that go into a cash account you could borrow against if you wanted to, although it usually comes out to be anywhere between 20 to 40% of the premiums you pay into kind of go into a cash, piece that you would have access to. So Brian, talk to me about, like, why it would be maybe a better option to look at a whole life plan versus term, and maybe how you help people navigate those waters.
Yep. So, and it also depends on the age of the person that we're talking to. Like, the older we get, the less we're going to qualify for a term product, and the more whole life is going to be the option. So I think traditionally we've all thought of whole life products as like burial coverages. We've thought about them as, in today's world, though, we're starting to hear more about using them to leverage retirement, building cash value, putting a policy in place for a small child, and fund that thing over the next 50 years, and then they have a couple $1 million in their policy by the time they're. But that's probably not the normal people that we talk to. The normal people that we talk to are trying to figure out how to either save their house or not put the burden on having car washes for their family when they pass away, so they can have a funeral. And I always ask my clients, so do you want more coverage for less time, or do you want less coverage forever, or a combination of both? And that kind of, that one little phrase I try to ask to all my clients so that it gives them because again, right, we're fiduciaries, we're here to help them. And I want them to tell me what their needs are, what keeps them up at night. And, whole life is, going to be a smaller dollar amount in theory. And I think the, for younger people, like we use that scenario of a 30-year-old, is your budget $65? Is your budget $120? Or do you want to use this for some retirement income and put $1,000 a month in? And I think that depends on who we're talking about and what the demographic of that client is, because we can go so many different ways with that,
Yep.
and it just kind of depends on, it's our job to really figure out who we're talking to so that we can really help them accomplish their needs and their goals financially for them and their family. So I think really, there's no really wrong way to protect a family as long as, I've always said, a mentor of mine back in when I first started used to say, Brian, the best coverage that you can provide for a family is the one that's going to be in place when they need it. And that's always resonated with me. And I tell my clients all the time, hey, the best thing I can do for you is put a policy in place that's going to be available to you when you need it. Now, that could be a term policy, that could be a whole life policy, that could be whatever it is. But we need it to be sustainable. So we need it to be able to fit in their budget, and we need it to be able to do what it, at the minimum of what it needs to do. Because we've all written, $5,000, $10,000 policies for a family, and we're thinking to ourselves, of course, our situation might be different than our client's situation, and don't ever let your situation dictate your client's situation. That's one of the things I've learned over the years is it's you gotta put everything that we've learned for ourselves behind us and just be like, how am I going to help this family in front of me? And if they want a cremation and they just don't have any money and they're living paycheck to paycheck off of $1,200 a month, and we put a $5,000 policy in there to where they don't have to have a car wash for their family, that means the world to them. That $5,000 means the world to that family, and we can't discard that like, oh, why did you get 20? You know what I mean? Like, there's a reason that $5,000 policies are available, because they're needed. And I think
Oh,
that's the biggest thing, is we just have to recognize that we are fiduciaries and we are there for them. And that could be a $5,000 policy. It could be a $2.5 million policy. But I think it's figuring out
mhm.
and asking the right questions of how we can help this family figure out what's going to be the best thing to put into place for them as far as that long-term solution. And you asked me about, how do you come up with that if it's whole life is best? And it's just really asking the questions of what they want it to do for them. Do you want this to be the last time we talk about this, or do we have a 10-year game plan, and then if we're still around, we go to the next step? It's kind of life goes in phases and steps. So, you know, we always kind of ask those
Well,
kinds of questions. How about you?
yeah.
What do you feel works the best with your clients?
Well, you're so right. It's all about the quality of questions you ask, and that's why again we go back to like, are you with a trusted advisor? Like, a trusted advisor doesn't start with what a quote is and then kind of backpedal to the need. What a trusted advisor does is they ask questions to uncover what your family's need is, and then they put together a custom plan for you. And this is why I always kind of laugh when people are like, maybe I'll have a client that requested some information and they'll just be like, hey, can you email me something? That would be like you calling your doctor's office and saying, "Hey, I'm sick. Can you email me a treatment?" No. I need like you to come in and I need to like ask you questions and I need to check your blood pressure. I need to look at your eyes. I need to look around and do some tests and I need to figure out what's really going on. And like, we're able to do these consultations very effectively. Like we meet with clients just over the phone, so it's not like, yeah, like when I first started in this industry, and I sure I know back in the day with you as well, we actually met with clients face to face. So I'm out here in Phoenix in Maricopa County. I could be from Sun City West, and then a 10 a.m. appointment there, and then at 1 p.m. I'm an hour and a half away, down in Chandler, and then Gilbert, and then Fountain Hills, and like we could be all over the map, running around all day long. And we had to find a time when people were home, and we'd get over to their house, and we'd ring the doorbell, and they'd be like a little note on there that's like, "Sorry, we had to run, to do an errand, come back tomorrow." And you're like, "God, I just drove an hour and a half to see them." So like now the way that we meet with families is just over the phone or over Zoom. All the phone calls I had, there was a couple people I helped with policies this morning that are in a variety of different parts of the country. One was in Illinois, the other one was in California, and I did that from my home here in Arizona. So we're able to meet with people, really on their terms. But we can't do it over email, and we can do it like a little bit over text, but not the whole thing. We want to really have a comprehensive conversation about what fits your need and like what fits a family's budget. And once we find something that fits a need and fits the budget, then we'll help you apply for it and see if you can get the coverage. So let's talk about like whole life. So in what scenarios do we write whole life policies? When I'm meeting with somebody, and especially if they're over the age of 60, that's like ding, ding, ding. We're trending whole life, with the exception of maybe they're in really, really good health. They're okay with a 10 or 15-year term, and they're okay with kind of the cost involved there. Generally speaking, over 60, we're going with whole life. And when I meet with people, I ask them the three reasons why they want to get life insurance. Is it because you want income replacement? Is it because of that debt elimination? Or is it because of the final expense? And they usually tell me all three. And I ask them to define it. So define like, what is income replacement? How much do we need there? How much do we need for the mortgage? How much do we need for final expense? And there was a conversation I had just this morning. It was with a lady who is 72 years old. And she said to me, I really want to make sure that my final expenses taken care of, my burial. And I asked her how much she wanted to have covered. And she said, I'd like to make sure they at least got about 25,000 to make sure that they, we were able to do a nice kind of funeral, and have that taken care of and not worry about any miscellaneous expenses. And then she also had a mortgage. She only owed about 50,000 left. So now we were up to about a $75,000 policy. And then she had a couple kids and a few grandkids, and she wanted to leave money to all of them. And I asked her how much, and she said, well, I'd really like to be able to have another, 100,000 or so that they could kind of split amongst themselves, to just have from me, and maybe to help with schooling costs, maybe to help with this, that, just whatever comes up. She wanted to leave a legacy. And I think that term legacy is important, because when people look into life insurance for any reason, they don't want their legacy to be somebody having to ask their friends and family to contribute, for their burials or to pay for their bills. And so when we looked at it, she wanted about 150,000 of coverage, but she's 72 years old. She didn't smoke, and she was in reasonably good health. But the problem is, if you look at $150,000 of term coverage, we can get that for about maybe 300-400 bucks a month. Or we could look at a whole life policy that's 150,000, which potentially could require us to stack a couple policies, because there are a lot of upper limits with whole life. With some companies, it's 40,000, some it's 50,000, some it's 100. So we would have had to stack a few policies, and it would have been closer to $1,000 a month to do that. And when we looked at her budget, she really was trying to keep it around 100, between 100 to like 150 bucks a month. So when we look at that, we have to make a sacrifice. And this is just an open and honest conversation that we have as the advisor. If I'm a doctor and I figure out that, we look at your height and weight, and we realize that you're probably a little bit overweight, like, I got to call the kettle black and be open and honest with you that maybe it's time to make some lifestyle and diet changes. It's the same thing for us as insurance agents. We got to be open and honest that they're going to have to make some adjustments in their expectations, but we will still find something. So now we're going to break down, we talked about leaving money for the kids. We talked about covering the mortgage. We talked about the final expense. Which of those do you think is like bare bones minimum the most important? And she said it's the burial. I want to make sure that no matter what, that $25,000 check gets to them. So what we did is we looked at two different solutions. We looked at one option that would provide, $25,000 in coverage, that would be able to help her make sure that burial final expense was covered. It came out to roughly $120 a month. We then looked at a second option that was more around 50,000, so it was about 250 a month, and it allowed her to have not only the burial but also a little bit of extra money there. And she decided it was the right fit to just kind of get that barrel taken care of, and we were able to help her with a policy. And so these are the type of common conversations that we have every single day is, what is the right fit for them? How are we going to help them? And just being open and honest about what's available. And there's some people where we can't maybe help them, and that's totally fine. We understand that this is not for everybody. There was someone that I met with yesterday, not yesterday because that was Easter, on Saturday, where we had the conversation, and she was really focused on getting at least 50,000 of coverage, but we really couldn't squeeze more than about $60 a month out of her budget to afford that policy. And $60 a month really only bought her about 10,000 of coverage. We looked at her budget, we looked at her finances, and in that instance, it didn't make sense to her, and we weren't able to do it. So understand, like, this isn't going to work for everybody. Life insurance is, everyone should have it, and I believe everyone has a need for it, but it doesn't always fit in the right box for everybody. So, Brian, whole life insurance, I want to kind of close the book on this because we spent a lot of time on it, but any kind of final thoughts on that?
I think really it's just just people need to remember whole life is to cover your whole life. It's permanent. It's a lot of times, they get that. What does it really mean? Well, just keep in mind it's going to take you to the end, right? I always tell people whole life doesn't have an expiration date. You do, and it's going to take you to your expiration date. So
Yeah,
that's all I have on that one.
that's good. And maybe just because we did show kind of a live example for term, let's maybe show a live example for whole life here. So let's say that we did have someone, they're 60 years old, 60-year-old female, non-smoker. And let's say that we were looking at a $25,000 policy for them. It's going to come out to $77 a month. So that means they're going to pay $77 a month at any point in their entire life. If they pass away, it's going to pay out that $25,000 death benefit. And I look at that from a couple of different standpoints. As I say, number one, the cost per that amount of coverage is really reasonable, because if you think about the average life expectancy for males is about 78 years old. For females, I believe, is about 81. So if I look at somebody who's 60 years old and they're paying $77 a month, let's just round, well, let's just call it 78 bucks a month. That's $936 a year. Now we have a $25,000 policy. So that means that it's going to cover them. It's going to take almost 27 years before they pay into this policy more than what the death benefit would be. So you talk about someone who's 60, add 27 years, that means that they're going to 87. The life insurance company is giving them the benefit of the doubt that you're going to exceed the average life expectancy by effectively 6 years. And Brian, when I look at that, I think that's a really reasonable cost of insurance.
Yeah, for sure, because that's upfront money if something were to happen to them tomorrow.
Yeah,
They've transferred 100% of their risk over to that insurance company,
for
and
sure.
that's a big deal. Hey Grant, also, when you were pulling that quote up, so that $77, the big benefit of getting a whole life policy at 50, 60 years old versus waiting until you're 75 years, because I've had people, why don't I just wait till I'm 75 when I'm closer? And it's because the payment's going to be so much crazier, and that payment's going to be set, so it's never going to go up during their time. So they know that they're going to be able to budget for that over the next however long, and they don't have to worry about their premiums going up every 5 years. That's kind of a thing that we've heard about, things in the past, or there's companies that'll do term and they renew them every 5 years, and then you get to a certain age and then it's like 14 times more than their normal premium, and it's like, I mean, you're basically
Yeah.
just, you're done at that point. So, you know,
Well, and that's good. Let's touch on that really quick. What that's called is a level premium and level death benefit. So level meaning it's they level the whole time of the policy. So there's some companies out there where they will start you at, let's say, that same policy we just looked at. It's 25,000 of coverage, but instead of $77 a month, they tell you it's $42 a month. However, every single year, or in some companies they do it every 5 years, that premium increases. Now, by the time you're 75 years old, that $25,000 policy is costing you $150 a month. So what we do is we do everything level. When you get approved at 25,000 for 77 bucks a month, no matter when you pass away, it's going to be 25,000 and you have been paying that $77 for the entire time. It's never going to change. So that's another thing to be careful of when you are shopping around is make sure that like if the premium seems really too good to be true, ask, is it an increasing premium? Is it going to stay level? Is my benefit going to drop off? Because maybe you pay 77 bucks a month for some companies and it starts at 50,000, but now by the time you're 80, they only have $10,000 of coverage. So that's another thing to take into account.
Yeah,
Um,
those are great points, Grant.
well, Brian, I think this is a good time to probably kind of call it for this session. I think we really just wanted to talk about, the term life, living benefits with in return of premium, and then also the whole life side to give a little bit of education around it. I think there's so much confusion in the marketplace. It's kind of a scary monster, when it comes to insurance. And, I just hope that you do find a trusted, advisor that you can really kind of have an open and honest conversation with about what your needs are and just kind of allow them to show you a few options. And if you feel that it's the right fit, then, go ahead and take immediate action to get a policy approved. And if you don't feel it's the right fit, then hey, maybe it's something to consider down the road, depending on your situation. But with that, I think we probably are overdue to maybe circle back on this for a part two where we talk about some more advanced market products. We'll just leave it very brief, but we'll just tease it as you can have a tax-free stream of retirement income using life insurance policies. You can take a 401k or an IRA and put it into a plan that's going to guarantee that your money grows as the market grows, but will have no downside risk. There's some products like that are really cool. And again, they're not for everybody, but for the right person, they can really help supplement their retirement. So I think we'll circle back with that. But man, I just want to thank you for spending some time with me today and providing a little bit of knowledge around these products.
It was my pleasure. Thanks so much.